Hey grade 10s, let's look at another year-end adjustment called trading stock deficits or trading stock surplus. As the words tell you, trading stock deficit means that there would be a shortage of stock. Trading stock surplus means that there would be an oversupply of stock. So at the end of the financial year, the business wants to know whether they have the stock on their shelves that matches what they've recorded in their books. So they close down for a stock take. When a business buys stock, it is recorded at the cost price. If a business buys the stock for cash, we would record that entry in the cash payment journal. If the business buys stock on credit, it would be recorded in the creditors journal. The entry would be debit trading stock, which increases our assets, credit bank if bought by check, or credit creditors control if bought on credit. The business then stocks their shelves with the items that they have purchased, ready for the customers to buy at the selling price. When the customers buy the goods, they don't pay the business's cost price, they pay a selling price. However, the business simultaneously records what the cost price is of the items that they have sold. So in this picture, you see that there are certain items that were sold to this customer. The business would record the selling price, what the customer paid, and simultaneously record what we paid for these items, which is known as the cost price. Our entry would be debit bank, which increases our assets, and credit sales, that is at the selling price. At the cost price, we would debit cost of sales, and we would credit trading stock to show that these items are decreasing our stock and leaving our business. So we now have less stock because we sold some items, and that's what our business is all about. We're about selling stock. When we get to the end of the financial year now, the business wants to know whether the stock on our shelves equals the stock in our books, what we've written and recorded in our books. Therefore, they do what we know as a physical stock count. They go and count every single item on the shelf. And they record their findings. They record how many items of a certain product range they have. In fact, of all product ranges. And they already know the cost price of these items. So they can then calculate the value of their stock on the shelves. So they want to know exactly what is the value of the stock to make sure that it matches the value that they have recorded in their books. By the way, what could cause us to lose stock? Think about it as we move on. Right, so we already know that the business recorded their purchases at the cost price. So in this case, the business bought 12,000 rands worth of stock, and we recorded it at the cost price. We bought it by check, so our bank was involved. We know that the business records the items that they've sold at the cost price. That's why we have credited our trading stock account with the cost of sales, telling us that 6,800 rands worth of stock was sold. How much stock do we have left? We have 5,200 rands worth of stock left, and we want to make sure that our physical stock count matches the record that we have in our trading stock account. So if our physical stock count, we have ascertained that the value of our stock on our shelves is less than that in our books, we know this to be a trading stock deficit. This is a loss to a business I asked you earlier, why do you think that we would have such a deficit? Why won't our trading stock account match the stock that we actually have on our shelves? Yes, there could have been theft, there could have been items that were damaged that we sent back to the supplier and didn't record. That's what we need to check, and that's why we are doing a physical stock count. We record this deficit in our books by debiting trading stock deficit, which is an expense and decreases the owner's equity, and crediting trading stock, which is an asset and decreases our trading stock account so that it matches that stock that is on our shelves. So now the stock that's on our shelves is equal to the record that we've made in our books because we've done an adjustment for the shortage. In our general journal, we debit trading stock deficit with 780, that's just an example, and we credit trading stock, not forgetting our narration. A deficit was determined after the physical stock count. In our general ledger, we then debit trading stock deficit, showing that it is an expense, and we credit trading stock to decrease our trading stock. We have our new balance of trading stock, which is equal to the amount of trading stock on our shelves. Okay, so now in this case it would be the opposite to a trading stock deficit. A trading stock surplus is the opposite. Now we have more stock on our shelves than what is reflected in our books. So our trading stock surplus account is an income, and we debit trading stock to show an increase in our trading stock, and credit trading stock surplus, which increases our owner's equity. And our trading stock account in the general ledger will increase to reflect the same value that is on our shelves. In our general journal, we debit trading stock, we credit trading stock surplus, and we then write our narration, not forgetting to underline the narration. Our trading stock in the general ledger is going to increase, and our trading stock surplus is going to increase as well. So that is your adjustments for trading stock, giving us a new balance of 80,000, which reflects the same balance of the stock that we counted in our physical stock